Welcome back to the Alternative Path Real Estate Podcast. Today we're joined by David Michaud, the founder and CEO, and Sadiq Alladina, Senior Investment Advisor at Parvis. Parvis is an investment platform that provides investors access to private real estate funds that are otherwise unavailable to the average investor through funds, direct deals, among other investment avenues. Before we kick it off, would you guys like to provide a little bit of color or history about Parvis?
Yeah. We essentially match private investors with alternative funds and real estate projects as well. We started exclusively with real estate products, and now our investors ask for a broader range of products, and so we have a lot of just alternatives generally. But we started the company about 4 years ago now, and we became licensed as an exempt market dealer about 3.5 years ago, and been processing funds ever since.
Just to give a bit more background, how'd you get the idea to start this kind of company?
Yeah, out of necessity, like all good things, right? I was working as a legal director for an asset manager in Montreal, a global asset manager, and I was also raising capital for my own real estate deals, a small boutique company that I own with my brothers. And that's when I fell into the exempt market space, at least on the retail level. And I just thought that the whole space was archaic. No one was really leveraging technology. And it's very cumbersome to process, an investment of $100,000 from a friend of a friend that just falls outside of the exemptions. So really, Parvis was built to do two things. First thing was to streamline the investment process from start to finish. And we built proprietary tech that does that. So we have KYC, AML integration, contract. We create a neat marketplace for an investor to conduct their own due diligence, review products, and then compare. And we have payment integration on the platform. So that was the first thing we wanted to do. And then the second thing that we wanted to do was to try to fix the elephant in the room, the lack of liquidity in private investments. So we set out to build a secondary market that's blockchain backed, really to enable our investors on the primary market to retrade some of the assets on the secondary. So that's been we've been 3.5 years in the making, and now we have about 55 different private investment products on the platform. We have about just short of 50 licensed advisors from coast to coast. We have a presence everywhere in Canada, and we processed about 120 million last year, which isn't too bad considering that our first million went through the platform just about 3.5 years ago, 4 years ago now, and we're on track to do a lot more this year.
Awesome.
What does it take to be an investor to get onto the Parvis platform? How do I qualify, become accredited?
Well, we don't decide if you're accredited or not. There's rules in Canada that set those terms. There's a bunch of ways to qualify as either an eligible investor, an accredited investor. But to answer your question directly, most people qualify by having a $200,000 yearly salary or a $300,000 yearly salary for the total of the household. That's how most people qualify, and there's about 4% of the Canadian population that are accredited investors, as opposed to about 35 to 36% that are eligible investors, meaning that they make at least $75K and up per year. It's a little bit more complex than that, but it really boils down to that.
Yeah, and would you mind clarifying? So that 4%, are you guys targeting just domestic Canadians, or have you started trying to expand to other geographical areas to raise capital?
Yeah, we have issuers on the platform that are active in the U.S. We have projects in Costa Rica, Mexico, and then we have investors from abroad, mainly institutional investors now, but we're definitely expanding. Just a few weeks ago, we announced the signature of the binding letter of interest to purchase a U.S. broker-dealer, so the equivalent of an exempt market dealer in the U.S., and we're hoping to close on that deal at the end of the month. So that's going to open the market to about 40, 30, 34, 34 to 30, depending on who you ask. Let's call it 35 million accredited investors in the U.S. as opposed to
It's like adding
2 million.
the full country of Canada.
It's always
To
times
the scale.
10, right? So, and the market's right next door, so definitely we're excited to expand on that.
Definitely a good example of growing through acquisition.
Yeah. And it's serious. Like, would that include funds in the U.S. as well, or is it strictly investors? I noticed that a lot of the funds on the platform right now are Canadian-based.
Most funds on the platform right now are Canadian-based, to a few exceptions. But obviously having a FINRA member, SEC-registered firm on there, we can load up new products as well. So U.S. issuers to match them with U.S. investors. But the goal is also to provide access to our Canadian issuers to a larger pool of accredited investors.
And speaking about kind of the real estate trends or the fund trends, is there any asset class you mentioned recently branching off into more alternatives that you're most excited about right now, or that you seem the easiest to raise for?
We're excited about a lot of things.
Yeah, I mean, maybe I'll just tackle sectors first. In terms
Yeah.
of sectors, we think that multifamily with a value add mandate or a core plus mandate is doing quite well on our platform. We have established issuers. I think investors can see why. They generate robust, recurring, inflation hedge cash flows. So those are really, really strong on our platform right now. We also have some new industrial offerings, which we're excited about. Time will tell how they perform, but based on what we can see, they've done quite well in the past, and we expect them to do well in the future. In terms of the broader asset class, looking at the general private market space, we have a secured debenture offering, which we classify as private credit, that is doing very well. It's private credit or a debenture issued by a fintech company. We've been very careful to look at the balance sheet of that company, and it's very robust and safe. So I think something that looks like fixed income is very attractive, that produces a return above the risk-free rate. That's something we like very much. We have yet to really do this, but we're excited to have infrastructure on our platform as well. For a long time, real estate was the asset class darling in the private market space, and hopefully one day it will return to that. But right now, based on my conversations in the institutional world, especially, infrastructure is highly favored right now. So as long as that infrastructure is in an evergreen fund, for example, that provides a certain amount of liquidity, because the contracts are very long with infrastructure, especially utilities and toll roads and so on. We'd love to have more of that on our platform. I should say that we're open to all sorts of private market investments, and I'll just list them to be clear. We have private equity, private credit, and then in the real asset space, we have real estate, infrastructure, and farmland. We like all of them, but we're very discerning. For example, private credit has come under pressure, and obviously look very closely on who they're lending to. But ultimately, we would like to have a full menu of offerings in private credit investments or private market investments. If I had to choose, I would reveal my bias: infrastructure and farmland. I think farmland is quite timely because of its inflation hedging properties.
No, I agree. Come from some family that are farmers, but they are down to earth people. But I love farmland for that thesis where it is buying a yield on agriculture. I'm not being too articulate there, but I love the feeling of being in the farm and looking at it and knowing it's so tangible, like a building.
And you articulated it just fine. I'll add that farmland is valuable also because I consider it, and I think David would agree, a highly differentiated product, and we do want to have that diversity on the shelf. And there aren't many opportunities to invest in farmland. I think there's one on the TSX, if I'm not mistaken. But like self-storage, which I can get into later. We're competing with the public markets. And in terms of farmland, for example, there are just a limited number of really good farmland investment managers in the market. So all the more reason to have one of them on our shelf and give investors that option.
I've had one conversation with a farmland investor, and it was like a whole other world. I had no idea that this was going on in Canada. If it was institutionalized, it's like in terms of a niche space, it's very fascinating that you guys are providing access to this.
Yeah, it's something that we intend to provide access, just to be clear. We don't have it on the shelf now, but ultimately the decision is up to David. All I can do is really persuade him. But I've always been a champion online product on the shelf. And I think hopefully one day we'll have that.
What we try to do is to have different types of assets in different geographies, right? Different asset classes, different geographies, to really build the leading private marketplace. So we have different types of qualified investors that come to the platform, and they look at different types of assets and they create a portfolio in the same way that they would do on the public side. So having a wider range of assets enables them to invest in farmland, private credit, or real estate. But yeah, we still like real estate. We're real estate heavy. We have a lot of people that come to us to invest in real estate, but now we are definitely expanding.
Hope you guys still like real estate.
Oh, yeah.
We have a strong bias to it. My domain expertise is in real estate. I'll also add that when David and I are on business development calls with prospective issuers and partners, I always say Amazon started with books and we're starting with real estate. But we intend to expand. And so we, again, not to belabor the point, but we want to make private markets investments in general accessible, not just real estate.
Feels like, because you said, I'm blanking on the word, but you made a crypto comment earlier about the blockchain. Sorry, that was the word I was looking for. It kind of sounds like the eventual goal is like Coinbase for private markets.
Most likely, yeah. We are definitely reading a lot about it and having a lot of conversations. It's definitely the future. So many efficiencies. Right now, we've only tokenized the secondary market just to make it efficient, just the flow of cash, updating the cap tables, and everything else. But at some point, we would want to definitely tokenize the entire platform.
Are you seeing a lot of velocity in that secondary market?
It's actually burgeoning right now. There's some leaders in the industry that just started on secondaries, and they're doing quite well. We opted to start with a strong primary market, which is what we're building right now. So to have a strong secondary, in my opinion, you need a strong primary, right?
Yeah.
And this needs to be sold at some point. And having both in one platform will sustain a lot of growth, because people that buy from us will also want to trade on our market. So in the next look, right now we're busy with a bunch of acquisitions. We also announced the acquisition of one of our competitors, Atlas One Digital Securities, that we're hoping to close at the end of the month as well. We're deep into DD and contract review. But the point I'm trying to make is that as the dust settles on these acquisitions, we work on integration. Then after that, we definitely want to use some working cap to scale up the secondary.
Yeah. That makes perfect sense. That's super exciting.
We are excited about it. I mean, at its heart, it is a liquidity solution. And I think what makes it interesting is that there are multiple use cases. So maybe I could just touch on that for a moment.
Yeah.
I think, the obvious example is providing liquidity to investors who want to exit their investments. And of course, for every seller, there's a buyer. So it also offers an opportunity, conversely, for a buyer to enter an investment that may be close to future subscribers. So that's an opportunity. The other opportunity is to rebalance a portfolio. We have a sophisticated investor on our platform that wants to maybe downweight real estate and upweight infrastructure. They could use the market to do that. A couple other interesting ones, and I think that's exciting. It's quite a versatile tool. One is companies that have private employee stock ownership plans. They have the option to trade those with each other, other employers, or with their employer. If they exit and the incentives are no longer aligned and they want to basically raise cash, they can use this as a mechanism. And another one that I think that is really new to me, I don't know if David got this, but basically estate planning and succession, where, for example, people inherit these private market investments and perhaps want to exit, and then they can use that as an opportunity to exit their investment. And I think the one aspiration, I think hopefully we get there, if this market matures and there are lots of buyers and sellers, and there's more liquidity and the bid-ask spread narrows substantially, it won't just be a source of liquidity, but it will be a source of information, because there's an opportunity for price discovery.
Yeah.
One can hope that we get to that point. There's this philosophy in real estate that I'm sure you're familiar with, that it's no matter how much you sharpen your pencils, it's not an appraisal that determines the price, it's the market that determines the price. So you have net asset value, which is basically an accounting estimate of the value based on appraisals. But if you can get a market where you have two arm's length participants transacting, I think that's a much more accurate price and very helpful to the market. So hopefully we get there, and of course, with all due respect to
Yeah.
Yeah.
I mean, secondaries in Canada, especially for real estate, is very much an emerging space. The last numbers I saw on secondaries, discount to NAV, were pretty wide of a spread. So it'd be nice to eventually get to that point. And then for every other type of fund to be able to actually use that as an exit opportunity for their investors would be, I mean, we've seen, especially over the last few years, that liquidity has become much more of an issue. So that would be very, very exciting.
I think it's a
That
very
information.
timely mechanism, given some of the gating we're seeing in the market and some of the halted redemptions. I think introducing a secondary market is really, to us, an integral part of our platform. And just, again, very timely given what we're seeing in the market right now. I think when the market is less frothy and more challenging, and we've seen the movements in the bond market in Canada and the US, I think people think about the two typical pain points, which are term and redemption provisions. So those are the pain points specific to retail investors. And the secondary market can be a solution to those issues.
Never total liquidity, but just having added liquidity, having the option of selling is appealing to a lot of retail investors. As we know, it can be a huge deterrent for retail investors to invest in some of these longer term products.
That's very exciting.
It is.
Glad you think so.
And do you mind quickly going back to that estate plan, that concept?
Mm-hmm.
So you have you have an estate plan, and you can go to the secondary market to find liquidity, or how?
Yeah, I'll preface my comments by saying right now I've just said it as an idea.
Yeah.
It's not fully formed, it needs time to gestate, but basically, the beneficiaries of a will, for example, named in a will, could have the opportunity to, for example, exit their investment or trade with other family members or other third parties if they wish to liquidate those assets. So if you would, for example, inherit maybe your pro rata share of a real estate fund, and you don't want it, you do have a market where you can basically raise cash.
And running both the primary and the secondary enables the traders on the secondary to have access to the data on the primary. So let's say in the context of a real estate deal that you sold an LP participation year one and then year three, and then there's a trade on the secondary, they can always go back and say, all right, look at the asset. The permits have been issued, the project is de-risked, and then the buyer and seller can actually set the price based on the evolution of the project and where it is now. It could be a haircut, or it could be increased depending on where it is.
And then for some other thoughts, for kind of key takeaways on the market right now for raising for retail investors, have you been able to see an uptick in velocity recently, or has it been a challenge? I've heard some different sentiments from other secondary market people I know.
Yeah, I think we all have an opinion on that because we're so close to it. It's been challenging. I don't think it's going to be surprising if I say that it's been extremely challenging in the past year. But there's still money to be deployed. There's people that can't really hoard these amounts of money for forever. And then the public markets have been challenging as well for a lot of investors. And because of that, we see public markets money flock to private deals. So there's it's been challenging to raise because generally speaking, whenever there's macroeconomic uncertainty or fluctuations, people tend to wait and see, and we have those right now. It's evolving.
Yeah.
I think the statistic is that a lot of high net worth investors have 2 to 3% of their holdings in private market investments, and the belief is that they can get up to 10. So, I believe we are on a wave that has not yet crested, and so I think mid to long term, David and I are very optimistic. Now, I would say right now, there are issues in the market. We are in a down cycle. The interest rates have gone up. The cost of capital has obviously gone up as a result. But I would say investors are cautious but not disengaged. They're still interested. It's really on us now to curate our shelf very carefully to really focus on sponsors that have incumbency experiences in various cycles. And really just make sure our due diligence is as rigorous as it can be. And I'll give you one example. Whenever we look at an offering, we'll look at the agreements, like the limited partnership agreement, the declaration of trust, the offering memorandum, the slide deck, or the investment presentation, which you've seen CIMs are incredibly useful.
Yeah.
And we used to see the financial model as something that was nice to have, and understanding that's proprietary and some issuers aren't very forthcoming. Now we're adamant that we have to have it. And the reason why is because we want to know what assumptions are embedded in the return. So we're really looking at these issuers with the same rigor as an institutional investor now. And I think in tough times, there was always a flight to quality, and we're just making sure that the managers that we have on our shelf are high quality.
Just to add to that as well, having the benefit of running one of the largest private investment marketplace in Canada, we get pitched all the time. We have developers from across Canada that call us and want $20 million yesterday for the best real estate deal in the century. So we know how these deals pencil in the current market in different geographies as well. So if someone is off on labor costs on a deal in Mississauga, for example, we'll know because we have that data because we looked at 20 other deals in the same location. So that's one of the advantages of running a marketplace. And Sadiq has been instrumental at looking at these deals and then pointing out which ones are good and which ones are not.
I'm bullish on real estate as well. I think there's going to be trouble in the public markets, and people are going to go to the private markets for durable cash flows. I think I don't know how it hasn't happened yet, but we will see. I think that could be very exciting for you guys.
Actually, getting deeper into the real estate itself, let's do like a little bit of almost rapid fire. Where do you guys see opportunities by geography in Canada? What's like most exciting?
All asset classes of real estate?
All asset classes, then we'll dive in. We'll go by asset class.
That's a tough one. I wasn't prepared for that.
I like primary markets like Toronto, Vancouver, Montreal. I think one caveat is that when it comes to ground up development, those can be very challenging places to build. I've been a development manager in Toronto. I've seen it firsthand. It's very difficult, but for income producing properties, I think those are great markets to be in. For development, we're right now fairly averse to high-rise development, whether it's purpose-built rental or condo. Everyone knows how bad the condo market is right now. And we've turned down opportunities with those kinds of build forms. But what we do like is mid-rise development in the periphery of primary markets and secondary markets, maybe wood-frame construction, shovel-ready sites. We really don't want to be caught in the middle of a planning battle with a municipality. So shovel-ready sites that really address the housing shortage and can be very accretive. So, those are kinds of development projects we like. Again, it depends on the sector, whether it's an IPP or a PUD, income-producing property or property under development. But we've definitely formulated opinions as we've gone through this market, and we do have a unique vantage point, like a pension fund that sees various external managers. We see various issuers, and we have a good sense of what fees are right, which market conditions are right. It's such an open-ended question. I'm more than happy to see sort of back and forth here.
We'll dive a little deeper. So IPP, we're talking major markets. Is there any asset classes that are more in favor? Are you seeing that your investors are more excited about in the IPP space?
When you say asset class, do you mean sector?
Sure. Yeah. Office versus industrial versus.
So out of interest, we're talking to someone very close to office. I mean, I'll make one comment, and this goes back to when I started in the industry. Pre-pandemic, you could have run a sector agnostic fund. In other words, you could have invested in office, retail, and industrial and had that diversification. Post-pandemic, I think the sector you're in really, really matters. And I would say I've heard that office is coming back, and it's not really apparent to people who aren't close to it. So I think there are bright signs there, or bright spots. And if this particular investor came to us with a value-add office fund, we might be inclined to put it on our shelf. For the most part, I would say multifamily and industrial are sectors that we really like. I think that's been affirmed by very well-known, reputable core funds that have those sectors that are overweight. Blackstone is a good example as well. I think they have a lot of multifamily and industrial. But we like those because their cash flow profile is robust, inflation hedged, recurring. Obviously, with industrial, you got to make sure that the covenant is okay. And we've also touted the inflation hedging characteristics of both. For multifamily, you always have an option to reset the rents to market when tenants roll. In industrial, the triple net lease structure is something we like, so you can pass on operating costs that can move up sharply. And hopefully, the rent steps negotiated in that lease are also sufficient to preserve the real value of that income stream. So those are the kinds of sectors that we really like as far as IPP goes. I'll also mention that we like the niche sectors as well. We have a couple
You
of
touched on
self-storage funds.
self-storage earlier.
We're very proud of what we have on our shelf. One of those self-storage funds is from a fairly reputable investment manager that is right now private. And they are institutional grade, which is a term I use a lot because we think that's high quality. And again, I'll make the point. I'll repeat myself. If you're a retail investor and you want to invest in self-storage, I'm only aware of a few options. One is the public markets with that one re-up on the TSX. The other options are on our shelf, where there are two perfectly good self-storage funds that you can invest in. So I think if you're sort of taking a contrarian position and saying, everyone's talking about industrial and multifamily, I want to do something a bit different like self-storage, you have your opportunity. We also like seniors housing and student housing. And the benefit of those niche sectors or subsectors is that they don't correlate strongly with your traditional commercial real estate, like office, retail, and residential, and industrial. That was the one I missed. So, if you have multiple private market investments in your portfolio or multiple real estate assets in your portfolio, they don't correlate strongly with each other. That's a good thing. Then you have benefits of diversification. So, sometimes it's not just the income profile and the return. It may be healthy. With the assets I'm talking about, I'm referring to really just low double-digit IRRs. But it's also the fact that, they have different value drivers and they're diversified. And on a risk-adjusted basis, when you look at your whole portfolio, you are better off.
That's exciting for me. I'm sticking to that value add office point. We just finished a couple significant lobby and office renovations with our funds, and our leasing has been fantastic. To hear someone else say, "Yeah, we're going on the up and up with office," big win. And then seeing recent leasing trends with industrial, it kind of reaffirms our thinking on getting those rent bumps and market leasing. So I feel like this is a good sign to be like, okay, we're past the bottom. Things are improving now. Would you kind of agree? Is that something you're seeing?
I think there are professionals in this industry, and this is strictly anecdotal, but I think there are professionals in the industry who probably wish the industry snapped back a lot sooner. But I think in the fullness of time, this industry will return to form, and hopefully to a point where it was similar to before the pandemic. So I'm very optimistic about real estate. I think it just needs time, unfortunately. One headwind is rising rates. The one comment I'd make, and I know you didn't ask this question, but I feel like I should say it. Your generation, my generation as well, has become very accustomed to the yield compression, which happened for a prolonged period of time. And if you talk to the old guard in this industry, they went through the 90s where they were psychologically burned and they didn't have the benefit of yield compression necessarily. One of my clients said it best. He was the former head of private equity real estate investment firm that everyone knows. He said, cap rate compression is not a birthright. So I think going forward, investors should realize that they should go with managers who know how to add value to real estate without really hoping for interest rates to fall. So I think going forward, more focus should be on actually adding tangible value to the real estate instead of just hoping that prices appreciate, you can sell it to someone else. I think that really should be the mindset, and it's the right mindset to have.
And with you guys expanding all these offerings, how can anyone that's listening or anyone that we know that we can recommend check out your offerings? Just through your website? You guys have brick by brick webinars. What can they do to get involved?
Yeah, well, they could just log into our platform. Essentially, they can create an account for free on parvisinvest.com, and we take a look at the account, ops and compliance, and we approve the account, and then they can browse through our 55 plus offers on the platform. And then if they decide to transact, they can speak with one of her 50 plus advisors. That easy.
Yeah,
It's that easy. I like that.
Well, guys, I really appreciate you guys coming in and taking the time to talk to us. Sounds incredibly exciting what you guys are able to do in the future. I'm going to check it out after, and I'm sure we'll have
I
a couple
hope you do.
listeners, and you'll see me hopefully as an accredited investor after.
Great. Well, thank you so much for having us.
Thank you for joining us.